Hello, we're on with Dmitri, the founder and CEO of Compli.Fi. How are you doing today, Dmitri?
Good, good. Thanks very much for having me.
Of course, my pleasure. So, give me a little bit about your background, how you got into crypto.
Oof, it was a long and winding road.
Okay.
For me, I guess more than for quite a few people, because I'm not actually a coder. I am an investment banker, sort of by earlier career. I used to work for Goldman for a while, doing M&A in financial institutions. So that actually proved hugely helpful. I suppose I stumbled into crypto kind of pretty late. You sort of start watching from the sidelines, and as a former investment banker, you're looking at what's going on at big raises, how they're done. And interesting, this cannot last. This is insane. But kind of if insane is the new normal, then you feel like you're the one who is insane now, so might as well change. So I kind of basically jumped straight in, and my first project, I think about 4 years ago now, was an attempt at an algo stablecoin, sort of round about basis time, just a little bit after them. I mean, hugely ambitious, hugely complex, a bunch of R&D. I mean, it was sort of hard going. In the end, sort of we did not go as far as kind of mainnet launch. And about a year, almost a year and a half now, I think, I again stumbled into derivatives. And again, you're watching this insanity happening in front of you, and you're thinking, oh, wow, things are blowing up. Some things can be done better. Let's just kind of sit down, put some math on paper, and see if you've got yourself a construct that could be useful to the industry, to the sector, to traders, to investors, et cetera. And that's how effectively Compli.Fi was born. And here we are kind of a year and a half later.
Okay.
Still hacking at it.
Yeah, of course. Okay. So you're saying 4 years ago, you were saying these big raises. What was getting like funded back then?
Oh, I mean, I'm pretty sure sort of infrastructure was still quite popular, and sort of layer one, kind of the fundamental stuff, got a lot of attention, rightly so. I remember sort of it was the beginning of kind of the Near protocol days. Solana, I think they were just starting out back in the days, and people were really thinking big. I mean, it was just if you could imagine it, you could get it funded essentially. And yeah, kind of basis was kind of like that, just like, let's create a monetary system that's just gonna replace everything. And yeah, I mean, I was guilty of kind of the same approach. I mean, if guilty is the right word. It felt right. It still feels right. We're kind of still in that mindset. I think that's great, and we're keeping it. We're just a little bit more grounded. We have a better feel at what can actually find traction quicker, earlier. And yeah, I mean, that's a helpful combination. I mean, now, I mean, the ideas that are out there are still sort of so diverse and rich. But I think everybody sort of, the devs that have been around for a while know what they can basically push onto the mainnet in a few months and sort of start making people money. And it's that experience, I think, that's a big sign of maturity for the whole industry.
Makes sense. Why were you attracted to the algo stablecoin idea back then? What was interesting to you?
I think, well, actually, completely forgot about that. So the last project I tried to get off the ground before crypto was essentially one where we try to kind of open up central bank money for kind of the general public. I mean, it was before sort of really crypto was on anyone's minds, and kind of before sort of Bitcoin was the big dream. We just said, okay, why does a regular person have to go through a commercial bank, basically get sort of leveraged with credit risk, and not having any choice to circumvent it. Like, why does that have to happen? Why would they just not kind of go to the central bank and get sort of the medium of exchange of their sort of their country for free and just kind of use it as a free service, again, critically without credit risk? And so we started talking to regulators and asking the question, would you guys kind of allow us sort of essentially to push through your regulatory processes, an institution which would just take retail deposits and place them on the balance sheet of the central bank. And on the back of that, we could have sort of payment instruments, et cetera, et cetera. But essentially, we'll just circumvent the whole commercial banking sector and go straight to the central bank. And we're talking getting rid of all the fees and all the, basically unnecessary intermediaries, like all the good things that crypto brings to the table. We wanted to do it within sort of kind of the central banking construct. And there was quite a bit of pushback. I mean, there were some surprised faces, but we did have quite a few supporters. And there was one particular sort of senior person within one of the EU central banks, of local central banks, that took it all the way to the Monetary Policy Committee, I think, at top EU level as an idea. But yeah, it wasn't really met with that much enthusiasm. And yeah, because I mean, it just kind of breaks down kind of an industry that has been in place for, I mean, I don't know how many years now, but how many centuries.
Right.
So kind of on the back of that failure, you have this whole crypto world exploding. And, if you have a piece of mathematics in your head, you can just kind of write the code, put it out there. The incentives are aligned appropriately. You've got yourself a monetary system. So we just kind of went right for it. Never mind the complexity, never mind the risks. We did like probably a year and a half of just pure R&D, just running essentially macro models, see how they behave, and yeah, sort of we got actually pretty close to deploying. Went as far as testnet, but no further, unfortunately. But that idea is still on the shelf, waiting for its time, basically.
I'm curious about that central banking model. I mean, how could the central bank, they don't have capacity to deal with that, like retail, people just sending them money, right? I mean, they got other stuff going on. That's not their business. I mean, I don't know.
I mean, in essence, no. I mean, there are kind of stages and sort of depth into which you can go in terms of what services you provide. I mean, back in the day, we were trying to do it. It was a sort of a simple starting idea. Essentially, I'm not even sure where sort of government bond yields are now. I kind of started following purely crypto and forgot about conventional finance. But at the time, you had sort of, I think, trillions of dollars invested at negative yield, just because, interest rates are where they are and just there was nowhere to go. And at the same time, central bank rates were sort of positive. And essentially that capital had no access to the central banking balance sheet directly to take advantage of those rates. So we said, all right, why don't we just create this little structure that would take on, $1 trillion or two, just a little bit here and there, and place it, onto a central banking balance sheet. I mean, a very pure, simple operation. We would do absolutely no lending, so there would be no credit risk. And we'll take like, I don't know, 5 basis points of $1 trillion. I mean, it's enough to feed a family, we thought. Yeah, I mean, definitely enough to feed a family, but they didn't let us do it, unfortunately. But again, it's a very simple thing. Even that pure service of letting people circumvent credit risk that is just forced onto them by the commercial banking system has massive amounts of value. And I think really the CBDC kind of direction is taking us there. Just a little bit later, through a more sort of systematic shift but ultimately the destination is the same. Like people are starting to realize that the banking sector have put themselves in a very privileged position where they're essentially the gatekeepers to to money. And yeah, they take their tolls, and I mean, you got to take off your hat to them. I mean, they've done pretty well, but I do feel a few things are changing, and yeah, that's not going to last. I mean, whether through sort of crypto as we see it now, or even directly by central bank reform, yeah, things are going to change.
What attracted you to finance generally? I mean, why'd you start working at the investment banks?
I mean, it's honestly, and I'm critiquing. It is not the same for everyone, so I'm truly sort of being self-critical here.
Sure.
It was a choice of one without imagination at the time. It was kind of the most prestigious job one could get, sort of when I was kind of job hunting at the time. And yeah, unless you have sort of a great skill, I mean, sort of practical skill like coding, which I did not have, that's kind of where you went. And obviously you got great experience, et cetera. You got to use your brain to some degree. And sort of that exposure to the big world, has its attraction, no doubt about it. So you just kind of go for it, and it gives you choice afterwards. So no regrets, really.
Yeah, yeah. I'm sure you learned a lot in that role, and definitely take a lot from it to your daily job now.
For sure.
I mean, I've never worked at a bank, but I assume now you have a lot more freedom, a lot less structure, a lot less kind of those corporate ideas that you have to cater to. Excuse me. I mean, do you feel like liberated in a sense, not having to, work in that regard, in that fashion?
I mean, definitely, definitely. It's kind of hard to even remember what it felt like sort of within a corporate structure, to be honest. I mean, as soon as you jump into that sort of startup environment, and you feel the empowerment, and you feel sort of the choice, and I think it's not even the freedom, but just the feeling you get when you take something from an idea in your head to sort of a tangible product that's there, and that people feel is useful. I mean, it's a great feeling, and it's sort of empowering, sort of in a very positive sense, just satisfying, I guess, is a better word. And that sort of soft ownership of the situation is yeah. I mean, it's great. It's great. You rarely get that in the corporate world, but again, it's a question of personal character. I know quite a few people who do find a lot of satisfaction in that corporate structured environment, and to each his own. For me, there's really kind of very little chance of going back. It is what it is. But again, I'm of the opinion that you really sort of have to, I mean, introspection is an important component in sort of in any decision and career choice. And if corporate life feels right for you, you got to sort of see it in yourself, know it, and make peace with it and enjoy it. I mean, I'm pretty sure I'm where I'm supposed to be, and I would like this to last. It's a good feeling. It's a good feeling.
There's a lot of people that want to make that switch, but it's difficult. I think that there is a sort of a mental hurdle. I'm wondering if you have, from your experience, what was that transition like? Did you try to build up a business like beforehand, or did you just say, listen, I don't like Goldman anymore, I'm going to do my own thing? What was that?
Well, I mean, in truth, it was a long process. And I mean, I think, I mean, it was a long, long path that sort of took me through stages that had nothing to do with business decisions. But ultimately, I think roads that lead to this sort of startup life are extremely diverse and extremely personal. What I think kind of unites all of us who've taken the plunge is, well, first of all, you cannot do it without just, I mean, near absolute self-belief. I mean, beyond any kind of rationality, realistically. You know, in the same moments, if you sort of look back and sort of analyze your own decisions, I mean, there is really no rational basis for starting to do what we do. But it sort of, if you feel that you cannot resist, and become sort of a question of just pure belief in yourself, then yeah, then you're probably built for this life. And I mean, you got to be prepared to fail, no question about it. You have to sort of make sure that in your mind, before you begin, you can make peace with a scenario where you screw everything up. Because probably, you know, quite often you will. And yeah, and you got to enjoy what you do. Otherwise, it would be way, way too hard. As I mean, we are kind of on a brutal schedule. And if you really have to count the hours as you do it, that's it. I mean, just there's no point. There's no point. But yeah.
What do you do? What do you enjoy most about what you do?
I mean, sort of my job within sort of, I guess, a big part rather of my job within the project is coming up with the mathematics behind the products. And essentially, I enjoy building things in my mind, I guess would be the best way to put it. Unfortunately, I have no skill set to build them in code, which was just, you know, feel like a huge, huge mistake in my youth in terms of, you know, choice of education. But it is what it is, and I have to adapt. And in truth, just sort of using my brain and knowing that it's not just sort of, you know, for fun and sort of the things that you can build in your mind, they're not just going to evaporate, that, you know, you're working as part of a team which is well capable of executing and making them a reality. And sort of the combination of the process of that building process and the knowledge that you're just a step away from making this reality, I think it's probably the most enjoyable thing.
What do you mean building in your mind? So what can you give me an example of something like
Well, I mean, sort of the protocol as you see it. I mean, in truth, it takes shape, like it took shape a year and a half ago, sort of not even on paper, but sort of I do a lot of math basically in my head as I imagine those things, and sort of I work with structure essentially in my head. And once it's done, I kind of put it down on paper. It's just a personal process, I guess. I've always worked that way. And you know, I could be working while I walk in the park, basically. And I can do it for a couple of hours, and then I, you know, come back and just write things down. And yeah, that's a good day at the office. I mean, you know, definitely works for me. And yeah, just, you know, it's hugely productive. It's hugely enjoyable. Kind of, what more can you ask?
It's amazing. I like that. I think it's very good to know within yourself that that is work, right? I think that a lot of people feel, oh, I have to be doing something right now. Oh, I have to like maybe even look busy many times.
It's a habit I've had to break, no question about it. Sort of, unless you've gone through sort of a whole cycle where, you know, the idea was born of this type of sort of walk in the park work, when you've seen it basically become reality and you know that kind of it's the real thing, then you sort of, I mean, you kind of gain confidence in yourself. It's a process, no question about it. It did not start out like this. like quantity of work and sort of just putting in the hours in doing stuff that may not necessarily matter is, I suppose, is kind of calming when you're under stress and you feel like you're doing something. You may be failing, but you're still sort of putting in the hours. But I think it kind of takes experience and confidence bred from that experience to just kind of press pause and kind of take a view on what matters, have confidence, and just follow through. And it takes time, and again, I think introspection and just sort of common sense and confidence ultimately.
So take me back to the early days of Compli.Fi. What was the idea behind this particular product? Like, why did it come out like this?
Basically, what precipitated Compli.Fi was a particular period, and I remember sort of quite a few DeFi protocols about a year and a half ago were having a few issues. One particular situation I remember is when MakerDAO CDPs got liquidated at near zero prices. Kind of they had to recapitalize, and just to make it clear, sort of, I appreciate deeply how hard it is what they have done at this stage when they have done it. And I've actually criticized that model quite a bit to quite a few people. But sort of, and I'm quoting this kind of, you would ultimately call it a sort of a screw up efficiency in the model, but still, I do it with the deepest respect and full awareness how hard it is to build something like this. But anyways, there was a situation where a few things blew up, people lost some money, and I was kind of looking at it and trying to get to the root of, what's going on, why is this happening? And ultimately, I arrived at the conclusion that it's a question of managing counterparty risk. And I mean, MakerDAO is essentially sort of a derivative protocol in a sense for one particular derivative, but still. And in derivative, you have kind of two parties essentially, and they have often a bilateral kind of agreement where, based on some change in the state of the world, the one who guessed it right, the winner, would get paid by the loser essentially. And in quite a few situations, derivatives in general have kind of an unbounded payoff function, as in the winner can get it so right that their payoff would be sort of just go almost to infinity potentially. In other words, you cannot quite often collateralize a derivative at the beginning, or sort of in very simple terms. If me and you, let's say, decide, I sell you an option, I cannot, like a call option, I cannot put on the table sort of enough collateral to cover any potential payoff. Well, with options, unless I actually buy the asset in the beginning, but for quite a few derivatives, it is almost impossible. And that's why sort of most derivative protocols that you see these days, they operate the whole kind of liquidation and margin call system. So if there's a bunch of collateral that kind of covers derivative positions, and as soon as some person's starts losing a lot of money and kind of eating through the collateral that they've provided previously, they get a margin call, and if they don't satisfy it, they get liquidated. And all of that happens because sort of the protocol needs to pay the winner, and the winner just keeps on winning, and you cannot get the situation so basically spiral out of control. And that's a complex thing to do. Like, as a loser at some point, unless you're threatened with legal action, you're just going to say, forget it, liquidate me, I don't care. I'm already sort of so deep in trouble that putting more collateral doesn't make sense. And in that case, the winner will just not get paid what they're owed. And that's sort of a problematic situation for derivatives. In sort of conventional finance, you've got yourself kind of the regulators, risk departments of investment banks, you have central counterparties, you have the fallback of the judicial system. All of those entities essentially help manage this counterparty risk. And I think I saw a sort of cost figure for managing that risk globally. And it was like 200 billion a year, give or take, just to make sure that counterparty risk does not get out of control, and which is insane. And what I was seeing sort of on chain is, protocols basically taking that margin call and liquidation system, forgetting the rest, basically ripping it out of context, coding it, putting it on chain, and essentially job done for counterparty risk management. So we said, right, there's got to be basically a better way. And what we came up with is essentially to create a system where every derivative that is issued by Compli.Fi can be, by design, fully collateralized upfront. And essentially, where it is appropriate, let me simplify it before I go deep into the math. Essentially, we take a piece of collateral, whatever it is, and we take any derivative that you know and love and kind of squeeze it into that piece of collateral. So essentially, me and you, as two counterparties to a derivative contract, would be dividing that fixed amount of collateral. And you or I cannot win more than the whole thing. And it's as simple as that. How quickly that collateral gets distributed between you and me, it's a question of specifying what derivative we want. What the distribution depends on, is it the price of ETH? Is it the number of rainy days, or whatever you want, whatever is measurable and can be or has been sort of imported as information on chain by some system of oracles, we can build a derivative on that. And you can manage the kind of design issues that follow from this approach. For example, like, people basically don't want their potential winnings to be bounded. That's fair enough. So what we do is we kind of shorten the time when a given derivative is active. That means that there's a much less, basically we control the chance that a given payoff will be capped. So you can only win so much in a shorter period of time. There are basically a number of design tricks that can enable a user experience that is the same as with any regular derivative, but throughout all of this, you have no counterparty risk. You have a guarantee that if you win, you will always get paid, and you'll never be asked for more money, i.e., you'll never receive a margin call. So essentially, we're kind of turning derivatives, the way you kind of logistically work with them, into simple tokens with some kind of intricate internal structure, but kind of they get the job done, and there's nothing you need to think about, nothing you need to deal with. Just buy it, hold it, sell it, settle it, and so you're kind of done.
That's very interesting. I didn't realize that you were coming from the idea of having fully collateralization and kind of shifting that model, actually. So in theory, if I'm understanding you correctly, you could use the similar system for stablecoins, for example.
It can be done. I think the big theme that is yet to sort of mature properly and crystallize as a need for the crypto sector is to have truly fully decentralized stablecoins. Now kind of USDC and USD, they get the job done and nobody thinks about them. Obviously, people are experimenting with various sort of incentive structures, et cetera, et cetera. The need is there. We know it. We just don't feel it yet. And yes, sort of this particular approach that we have can be used to create a stable coin. Now, the very simple thing you can do is create sort of a finite horizon, sort of a stable coin that periodically settles. Now, it's not particularly convenient for transactional purposes, but it's sort of a stepping stone. Now, obviously, you need to start with a piece of decentralized collateral. So let's take ETH, for example. So what we can do, and we have actually a derivative that does exactly that. We've not really deployed it, but sort of it's on the menu. We just had kind of a lot to do. Essentially, you take a piece of ETH and you split it into two parts. One is a stablecoin, and the other is ETH leverage times 2. So essentially, every percentage change in the price of ETH would affect one derivative doubly and the other not at all. And kind of there you go. One is sort of a stable coin and the other is a leverage token. The stable coin is going to live sort of for a fixed period of time. For a number of reasons, it's sort of critical on that fundamental level. But let's say sort of for a month. And what it's going to have if essentially what it's going to have is specific default guarantees. What you can do, sort of the very simple thing that you can do is to say that unless ETH declines by more than 50%, you get yourself sort of a fully sort of a complete dollar peg. You have no default whatsoever. And then you say, all right, so in what period of time do you feel comfortable that ETH will not decline by more than 50%? It can be a month or 2 months or 3 months. And you essentially issue yourself a derivative where one side gets double the risk. And I mean, essentially probably close to what the holders of residual interest in the maker CDP have. And the other is your pure stablecoin. And sort of after that period, let's say 3 months, it settles. The holder of the stablecoin gets their sort of dollar amount, a fixed amount unless that default occurred. And sort of the second holder of that leverage token gets whatever they get depending on performance of ETH. So that's your sort of basic design of a sort of basically a finite period stablecoin, a stablecoin with settlement. Now, obviously, it is much, much less convenient than, let's say, DAI, where it exists theoretically in perpetuity or unless the system breaks down. And if you want kind of true adoption and traction, you need to solve the problem of that periodic settlement. Now, we are actually working on that. It's sort of a product that's not simple from a number of perspectives. First of all, it's not just a derivative. You really need sort of to push for adoption outside of your own platform. You need to explain it to people. You need to sort of make sure it permeates various other resources. And Maker has put in a lot of work to achieve sort of just that. And again, I realize how much work it is. So a lot of respect. But kind of the way we're looking at it is, all right, so we have that basic derivative. Let's next create a mathematical model that perpetuates this basic construct. And we are actively taking steps in that direction. We do not have a launch date yet. Yes, it's very much an R&D project, but we are quite sort of bullish on the idea.
Very interesting. So why did you decide to start with the 5x leverage tokens?
That's a good question. The choice of, well, I mean, in truth, what we started with was basically a synthetic risk factory. And let me kind of take you a few steps back to kind of the beginning of the journey. So when Compli.Fi started, we created a mathematical model that essentially eliminated counterparty risk. And the way we started off in terms of implementation was to build kind of our issuance protocol. And that thing is, the analogy we use pretty much all the time is a synthetic risk factory. So if you come to it as a user with a bunch of collateral, kind of value in any form, and you kind of put it in there, on the other end, what you get is the same value back, but in form of 2 piles of ERC20 tokens, the short position and the long position tokens in a derivative of your choice. And together, essentially, they form a riskless, fully hedged derivative portfolio. So kind of really the same value with risk structure stamped over it. And yeah, it's a riskless transaction, great. And our thinking at the time, which was, I think it was autumn last year, was to say, okay, so we've got this factory. Let's talk to sort of the Uniswap and the Balancer LPs and say, listen, you're holding a bunch of value in liquidity pools. And you got fairly mundane assets, the returns are not great. How about instead of keeping kind of your ETH or your stable coins in those pools, you take them and use them as collateral, put them into our synthetic risk factory. You mint yourself an inventory of derivatives, which are much more exciting and kind of potentially in demand if you choose the right kind of things to mint. And you then stuff them into the same AMM pools that you have been using, and you stay in the same business, just with a better product. Trading can be more active. You can charge more fees for a more unique inventory, et cetera, et cetera, et cetera. And kind of that narrative found quite a bit of traction. So people, said basically it makes sense. Okay, so we said, great. Let's see if we can sort of kind of integrate our factory into an AMM and kind of create a whole seamless flow from collateral to an LP position in derivatives in a balancer in Uniswap or a curve pool even. As we kind of started working towards that goal, we kind of started experimenting a lot, just running simulations, asking a simple question: what happens if you put an extremely volatile instrument into your constant product AMM pool? And well, it very quickly became evident that it is basically a bloodbath. It just doesn't work. You got massive impermanent losses. I mean, it's just all over the place. And the worst thing is that since you have a finite, basically finite settlement, an instrument that will settle, let's say, in a month, at that point in time, what happens is that impermanent losses crystallize and become permanent. And, LPs just get slaughtered. I mean, sometimes obviously you'll win, but as an LP, you don't want to be dragged into a massive derivative exposure and potentially like lose half the value of the pool. I mean, it's basically insane. So it's all right, let's kind of press pause on that and build our own AMM and attach that essentially to the risk factory we already have. And so we spent probably 3 or 4 months building it out. And there were a couple of, there's a huge number of things we did in there, but a couple I think that are sort of AMM defining for us is essentially, one, the way we handle impermanent losses. And we do it very simply in a sense that in every block before the first trade, the AMM uses the Oracle to reprice all of the derivatives that it offers for sale. So whereas in, let's say, Uniswap, arbitrage would shift the price along the invariant to the new point, the AMM that we have actually shifts that point by itself without any arbitrage and starts trading from that point in every new block. So that's a massive, massive protection mechanism for LPs. And obviously, when you've got your 5x derivatives, it's critical. So that's kind of one. Second, we said, all right, so you have your derivatives who currently submit USDC liquidity, and and we're essentially turning that liquidity into long and short derivatives, putting them into the pool, and as trading goes on, basically inevitably, LPs will have a net derivative position one way or the other. Either they'll be positively or negatively affected by, let's say, ETH going up. And sort of still, it's not great. We don't want LPs essentially to find themselves with massive market exposure and get burned. So how do we manage that? So that was kind of the first kind of initial stage of our kind of the build out of our risk management system within our AMM. And kind of the key sort of cornerstone element of that system is kind of based on a very simple idea. So let's measure exposure in a very simple way. So you have, let's say for the X5 derivatives, we have the X5, let's say ETH X5 up derivative, which goes up five times faster than ETH and falls accordingly, and ETH X5 down, which is basically your short position. ETH goes up, it falls 5 times faster. And you have those derivatives in the pool. And when their quantities are equal, it means that the pool is fully hedged and it's the same as LPs holding USDC. However, when traders come and trade it out of balance, LPs have more of one derivative than the other. So what we do is we measure exposure. Essentially, we measure the distance under some definition, how far from that symmetry of the pool would a given trade take the LPs. And the further away a given trade kind of pushes the pool into risk, the more expensive a given transaction becomes. So that's kind of the concept of our dynamic fees. Again, sort of in Uniswap, you pay a percentage fee for your trade, and that percentage is small, and that's great. With us, we calculate the trading fee for every given transaction separately, because it's based on a simple idea that the more risk a given transaction causes for LPs, the more they should be compensated for it. And we simply kind of coded that mechanism. And we ran some simulations as to how LP value would behave, and it looked great. So we said, all right, let's go for it. It's not really a risk management construct that at least I have seen directly in sort of in classical finance. It's very specific to the way we manage counterparty risk, the fact that, all derivatives operate within a fixed amount of collateral, et cetera, et cetera. It was sort of a custom built sort of construct, sort of protection mechanism. And there's no sort of, obviously there is some sort of scientific evidences that, it should do the job to some degree, but it is not a classical risk management tool, I think, by any stretch of imagination. So again, we extensively simulated its performance, and it looked great. So then we launched, I think it was spring this year, and sort of basically watched the pools for, how would they behave in reality kind of versus simulations. And essentially throughout, sort of for every series of derivatives that we've had since the beginning, sort of the actual behavior was within the range that we saw in simulations. Honestly, we're extremely surprised. We didn't expect that, actual real world performance to be as close to what we have expected. And yet here we are, kind of obviously diversification across derivatives for LPs is key, and kind of there are things, common sense things that need to be done to risk manage sort of beyond what the AMM pool itself offers. But what we have found ourselves with is essentially a derivative risk management system that kind of consistently has delivered up to this point across different market conditions. We've seen sort of market collapses, we've seen rebounds, and LPs have performed, so far extremely well, we found. So we've run usually, and in recent times, 4 pools, and now we'll be expanding that set. But what we found is if you are an LP in sort of reasonably evenly across those 4 pools, you have made a great return since the launch of the protocol. And now I think we're kind of measuring our APY at close to 40%, which is, I think, amazing. These are 40% in USDC so far. These are not forward-looking figures. That's basically what has been achieved. And we're talking kind of generation of raw value. There's no farming in there. There are no kind of, governance token top-ups that you have to sell to kind of realize that figure. That's just raw USDC returns. And honestly, we're extremely happy with where we are. And now we're just going to have to kind of optimize it, clean it up, and kind of scale it. Yeah, we're pretty happy.
So the AMM you're using is something that you came up with on your own. You're not using the constant product model. Am I understanding that correctly?
It's not as simple as that. Essentially, the invariant that we use is a variation on a constant product. It's kind of a leveraged constant product. What's the easiest way to explain it?
Yeah, my math knowledge is not very good. So
all right, no, fair enough. Let me just sort of I'm trying to kind of think of an easy way to visualize it. I mean, have you sort of seen the constant product kind of invariant curve?
yes.
I mean, literally just that famous Uniswap curve. And that thing is hugely powerful. Honestly, the more I work with it, the more respect I have for it.
Okay.
And what we do is we have a mechanism that essentially allows us to freely pick any point on that curve, anywhere. And essentially that means we have control over, over price that we're offering. In Uniswap, price depends on the relative amounts of each asset that you have in the pool. Our AMM can detach price from essentially inventory. It can set any price, which is hugely useful for derivatives since we reprice them in every block. Essentially, given any invariant curve, we can move that point to the right place and then start trading from that place every time. That's your kind of solution to impermanent losses, to a not completely, but to a very, very significant degree. The second thing we can do is essentially use those leverages that we play with to kind of scale that invariant. We can, in simple terms, pretend there are more assets in the pool than there actually are. So we kind of blow up the invariant, keep the same shape, but just expand it. Or we can pretend there are less assets. So we increase slippage, we kind of contract that whole invariant, we scale it down. And all of that, we just can do freely independently of what the pool is actually holding, what liquidity actually is inside the AMM. So we pick the price, we pick the slippage. And then, for a given derivative, we feel, all right, so this kind of slippage is right, we can easily choose it. And kind of picking the price in every block works for all of them, basically. Does that make sense at all?
Yeah, it's like kind of instead of having it automatically flow, like in Uniswap, you kind of freeze it along certain points depending on how you want the pool to trade. Like you can't push it to over a certain limit or under a certain limit.
Well, I mean, in truth, in the latest version of Uniswap is something that's similar to what we do, but sort of they went in a different direction. But I think those leverage coefficients, I think they are, if I'm not mistaken, I've seen a white paper in winter, I can't remember, probably February something, where they've used a similar piece of mathematics to gain control over pricing. So I think that's a technology that is has been adopted lately by quite a few protocols. I mean, we kind of developed it from scratch, but I would not be surprised that quite a few people thought of it in parallel and have coded it and use it. And for derivatives, I mean, it's great. I don't think there is a second implementation that's similar to ours in the derivative space. Hell, I'm not even sure that there's much in the way of derivatives automated market making at all currently on chain, because it's extremely hard. And yeah, that's why I'm really extremely happy with the way our AMM performs.
Yeah, that's one big problem, especially for options protocols. They don't have much liquidity.
But it's not even liquidity. It's kind of being able to offer terms of trade for options as the market evolves. I think some of them are resorting to kind of OTC, which doesn't make sense. We are probably going to sort of deploy options quite soon, if not in a week, but that sort of a time horizon. We're just kind of finishing off that work stream. And essentially, our AMM can handle options the same way it handles X5 derivatives, kind of leverage tokens. It just prices them and offers traders kind of terms pretty much in any state of the market, all algorithmically. And LPs essentially, I mean the key here, the options that we're going to offer are covered call options, and I know quite a few protocols kind of experiment with it. And sort of the great thing with them, if you really can offer dynamic trading, is that, let's say you hold a long-term position in ETH or in any token, I don't know, in Link, and there are sort of not too many ways to generate returns on your token. I mean, you can place them into lending protocols for, a fraction of a percent in APY, does that make sense? You can place them into sort of a regular AMM liquidity pool, but returns from what I see are not great unless topped up by farming. But then, you get into a fairly sort of dodgy territory. But essentially, in terms of generating raw value, there's not much in terms of opportunities. But sort of what we're aiming for here is to have essentially an options pool where LPs, let's say, put their native asset in there. Let's say, stick with the Link example. And what we do essentially is chop off the potential upside on top of this token, turn it into a call option, and enable trading in it. So LPs, their downside kind of remains the same being as if they held their token in their wallet. But what's happening now is that they're able to generate fees with the potential upside of their token by letting traders kind of buy and sell a covered call option. So if APYs on that product sort of look anything like the APYs for the X5 leverage tokens, I mean, we feel it's going to be sort of a groundbreaking thing. I mean, if 30-40% can be achieved with sort of reasonable risk comparable to one where you just hold a given sort of strategic token position, generate 40-30% of APY on something like ETH on Link, just without any farming. If that can be achieved, I think it'll be a massive step forward. So hopefully within the next few weeks, we'll try and push that onto mainnet.
I mean, the LPs in this options model, they can still lose. I mean, if
you can always lose.
Right.
No, I mean, you cannot. I mean, there's no way you can essentially generate any serious returns kind of beyond the risk-free rate by not taking on any risk. But what we're saying is, let's say you have 1 unit of ETH. So you're holding it in your wallet. If it goes up, great. If it goes down, there's your downside. And what if I tell you, listen, how about, say your ETH is, I don't know, let's say 2,000 now. We sort of lock your ETH, not lock, but let's say keep it in a liquidity pool, and we create a structured product, which is a call option on sort of backed by your unit of ETH with a strike price of, let's say, 2,100. So we just write this option and we sell it to some trader for $100. So now the $100 goes to you. So now you're sitting on sort of $2,100 in value, feeling great, and your ETH, is basically still 2K. Now some time passes, and one of 3 things happens. Thing number 1, it goes down, let's say to 1,900. Yeah, all right. You've lost $100 on your piece of ETH, but you've got your price that was paid for the option, your $100 in your pocket, so you're feeling great. I mean, obviously you may still have lost money or not broken even in this example, but sort of you're better off than what you would have been if you kept your ETH in your wallet. Example number 2, let's say ETH goes up to 2,050. So it's below strike price, but it's up a little bit. So the option that you sold is out of money. you basically gain $50 off of your ETH position, and you've gained $100 by selling the option, which is not going to be exercised. So you're better than what you would have done sort of if you just kept your ETH in your wallet. Now, example number 3, ETH goes just to the moon. Let's say 2,500. So if you just kept it in your wallet, you would have had 2,500. But since you sold the call option with a strike at 21, the trader that bought it basically exercises it. So of the 2,500, 400 goes to the trader, but you still keep the price they paid you. So you're basically, in our example, you're at 2,200, but you could have been at 25. So, all right, in here, you lost $300, and that's kind of the risk. In both other situations, you've done better than by just holding the ETH in your wallet. So essentially, there's a risk here, and I'm simplifying this massively because there could ideally be a lot of trading. So somebody buys the option, sells it back, buys again, and you keep on generating fees, and they kind of build up the cushion against a situation where things go through the roof, the option pays out, and you kind of lose versus what you could have gained. But still, that's kind of how you generate value. And statistically, we're aiming for that process to kind of generate the kind of APY that the X5 derivatives are kind of have been generating now for LPs. Similar process, very different product.
What's your biggest challenge right now?
Honestly, to get through the noise in the industry. There's so much going on, and sort of I think people's attention spans, and rightly so, are extremely short. And to sort of explain to in whatever form that there's depth to your product that has been delivering, that it is sustainable, it is truly sort of value generating, versus something that kind of moons, then crashes, then it's extremely difficult to do. And when you start talking derivatives, you try to simplify it, but there's just so much math, and you can only get away from it to a certain degree. We simply, and that kind of circles back to your question, why we chose the X5 derivative. We felt it's kind of the simplest instrument we could build, in the sense that you have something that starts at $1. It can go to 2, or it can go to 0, or to anything in between. And it'll go there 5 times faster than whatever its underlying asset. I mean, sort of as simple as that. Options are harder, in my view. Sort of various other structured products are harder. We needed something relatable, and sort of something where a user, somebody who basically buys it, can just watch sort of some simple metrics and clearly understand why they won or why they've lost and what's happening. And we felt like that's the product. And so getting back to your question, I mean, honestly, that's the challenge. Sort of the amount of marketing thrown at sort of crypto users is absolutely insane. And even sort of, I've been around for a while, and obviously I've sort of dug into quite a few projects. When somebody throws, an elevator pitch at you, and I'm talking sort of on Twitter or somewhere, and essentially declare some APY figures, it takes me time to kind of read what they've done to form an opinion. And I can only imagine, how that mental journey goes for, somebody who's just kind of a regular user who's not built something in DeFi. I mean, how do they even absorb all that, process all that information, differentiate between, what's crap, what's not? Honestly, I don't know. And that's truly sort of, I think, the biggest challenge for a complex product. We have to sustainably and verifiably show that the APY that we're declaring, it's been what it is now basically since the beginning. This is how we got there. This is where kind of the risks crystallized, and there's a dip. This is where people lost money. That's why they lost money. But statistically, it evens out. Everything is fine. Everything is great. And risks exist. You have to be aware, but we can manage them. It's not sort of, to the moon and then basically back to Earth. And to basically condense that message, into some bite-sized pieces and, push it out into the world is extremely difficult. Yeah, if that makes sense.
Makes sense. Just got to stick around for a while. Keep on working.
Yeah, that's pretty much the plan, to be honest. We've been at it. Yeah, so far so good.
So what's the best way to get involved?
In Compli.Fi? In what sense? Get involved in what?
I don't know. Check it out. Get to know it a little bit better.
Get to know it. Oh man! All right, listen. Just go to the app, see what it says. Join our Discord community. If there's something you do not understand, just ask a question. But our job, in essence, is to kind of. I'm not a big fan of this analogy, but essentially to become Uniswap for derivatives. And in the best possible way, take something complex and make it simple. Because Uniswap is basically it. You have one token, you have another token, you kind of know what they are. And here's the price. You want to buy one, sell the other. Excellent. We kind of want to do the same thing for derivatives, but on the side, we need to explain you what these derivatives are. Because each of those tokens that we present has a bunch of internal structure. So we're saying, okay, right now, what you see on our app is, it's not the best we can do yet, but it's kind of the simple way we've arrived at showing kind of, what a given derivative does. And, have a look at it. Make sure you understand it first. We try to make it simple. We try to say, listen, here's a token that goes up faster than ETH or goes down faster than ETH. Is that, do you have a market view, a strong market view that's, which you want to turn into sort of, do you want to put your money on it, sort of, accumulate risk and just, make a big bet? Kind of that's an instrument. That's an instrument for you. Kind of understand what it can do, what it cannot do, ask the questions. There's a lively debate as to, what the instruments should be, what's good, what's bad about them. But first and foremost, do not just kind of look at the APY figure and say, all right, looks great. I don't want to understand it. I just want that number. Derivatives are risky. They're great, but they are risky. Just understand what's in front of you. Ask us. We're hoping just, not to just build a great product, but essentially to build understanding of our product and make sure that, every trade that is made is a conscious and educated decision that, basically we empower a person who wants to capitalize on a strong market view. But you do need to have a strong market view, and you do need to understand what is in front of you. And I mean, it's extremely interesting. I mean, it's not a boring way to spend time. So kind of join the community, dig in, and we're kind of here to help.
All right, Dimitri, thank you very much for taking the time. I really appreciate
Thank you.
it.
Great chat.
And hope we can do this again soon.
It would be excellent. Thanks.